Hello and welcome to this week's instalment of Nucleus Investment Insights. Today we turn our attention to the remarkable recovery in Australian jobs over the June period as the nation grapples with the Delta variant of COVID. With the national level now at 4.9%, unemployment is 0.6 percentage points ahead of the federal budget's forecast for June, and the result comes after more than 115,000 people found work in May. Reserve Bank Governor Philip Lowe has come out saying that the central bank will expect that unemployment will need to be sustained in the low 4s or 4% for full employment to happen and to put broad upward pressure on wages. There were around 362,000 job vacancies in May 2021, which is the highest number recorded in Australia, and 69,000 more than February 2021. In fact, this is the tightest job market seen for decades. But of course, these figures have happened before the most recent major outbreak of COVID-19. So now the question remains, can this recovery be sustained, or will the lockdowns in Sydney and Melbourne ruin the rebound? Here to discuss these remarkable times, we're very fortunate to be joined by a former senior policy advisor at the UK Debt Management Office. He's a former economist with the New South Wales Treasury and now has earned the rank of Head of Australian Economics for the Commonwealth Bank of Australia. Gareth Ed, welcome back to Nucleus Investment Insights. Also joining us on the line is our own Head of Australian Economics, Leith van Onselen. Hello to you, Leith.
Yeah, g'day Tim, g'day everyone. Hi Gareth. I'm sorry I'm not on camera today. My internet is playing up quite significantly, so I'm getting pretty slow speed. So I'm just dialing in wirelessly. So you're welcome to see my ugly mug.
I wouldn't go that far, mate. You're just enjoying that NBN experience. And also here to share his thoughts on the future of the remarkable jobs recovery and how, of course, they may influence our portfolios. I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Good to have you on as well. Just a quick reminder before we get started, if you haven't already, subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So let's jump into it for today. So our agenda for today is going to kick off just around the top topics, I guess. Australia's unemployment rate fell to the decade low in June. Talking around the tightest job market, as I mentioned previously there, some of the drivers, so stimulus and closed borders, how low can unemployment go and what might it translate into, or will it translate into higher growth, I should say. Will the current lockdowns ruin the rebound? It's going to be quite interesting to hear the gents' thoughts on that one as well. And then, of course, implications for monetary policy and really just, sort of seeing where the RBA might go from here as well. So with no further ado, we'll kick off today's show. It's going to be a huge one. We've got a handful of guests. We've got technology up and down, but we'll get there. I'm really looking forward to it. Leith, a spectacular labour market rebound, mate.
That's right, mate. But this is all backward-looking stuff. So if I was to have this chat 2 weeks ago, I'd be high-fiving, or 3 weeks ago, more like it, because obviously we wouldn't have had lockdowns across Sydney, Melbourne, in South Australia, which obviously could dampen the party going forward. So this analysis I'm about to present is pretty much backward looking and covers the recent rebound rather than what's obviously facing us in the period ahead, which we can talk about a bit later. But putting that aside, the June labour market numbers came out last week and they were quite frankly spectacular. Australia's unemployment rate fell to a decade low of 4.9%, which again was the lowest we've seen, I think, since June 2011, so exactly a decade. It's totally obliterated the RBA's forecast, which basically forecast, I think, double that at around about this time. And the spectacular thing is this came at the same time as the employment to population rate for 15 to 65-year-olds also rose to their highest ever level of about 76%. And just to add a further cherry on top, the number of job ads per unemployed and underemployed is now running at the low on in recorded history, in records dating back to around about the early 1980s. So it's a absolutely spectacular jobs rebound that's pretty much obliterated everyone's forecast, and it's quite frankly amazing where we've gotten to think that only a couple of quarters ago we were experiencing our deepest recession since pretty much the Great Depression, and now we're experiencing pretty much the tightest job market I've seen probably in my lifetime.
Yep.
And the lowest unemployment rate for about a decade, and an underemployment rate we haven't seen pretty much for about 7 or 8 years. So it's quite a remarkable rebound. Now, the way I see it, there are two major drivers of this, which Gareth can speak to quite frankly, because some of this research actually has come from him. And effectively, the most obvious one that we've all seen is the enormous stimulus package. So we saw hundreds of billions of dollars pumped into the Australian economy, which has obviously boosted labour demand. But the less obvious thing is that we've actually had Australia's labour supply grow far more slowly than we've seen over the past 15 years, due to firstly a decline in non-resident workers, so temporary workers across the economy, as well as fewer migrants arriving because of obviously closed border. And what this has meant is that basically with the strong uplift in labour demand, butting heads with reduced labour supply, we've seen a big shift downwards in unemployment and underemployment, and an incredibly tight labour market. And in fact, the Guardian's Greg Jericho, economist at the Guardian, forecast a few days ago that if the labour market had grown at its pre-COVID rate, Australia's unemployment rate in June would have been about 6.2%, not 4.9%. So effectively, not having so many migrant workers arrive, pre-COVID we're getting about 180,000 a year, has meant that Australia's labour market has tightened quite significantly, and that's obviously pushed down unemployment and underemployment, led to a massive tightening in the labour market, and should hopefully follow through with higher wage growth in the future. And before I kick it over to Gareth and just ask his thoughts, I'll just skip ahead one chart. Historically, wage growth in Australia correlated fairly strongly with the underemployment rate, and the underutilisation rate, which is both unemployment and underemployment combined. And basically, the last time we saw an underutilisation rate of 12.8%, which is what it is currently, was around April 2013. And basically, the Reserve Bank reckons that for us to see wage growth would go back to around 3%, which we haven't seen over a decade. We effectively need to see unemployment fall below 4.5%, and obviously underutilisation to fall alongside that. So pre the current lockdowns, as of this data, Australia was facing a situation where the labour market was getting incredibly tight, and we were more than likely going to face some decent wage rises, and in turn, rising inflation as well. So that's pretty much the 20,000 foot summary there of the Australian labour market as at June, pre these lockdowns. Incredibly tight, smashed everyone's forecasts, and delivered by huge stimulus alongside closed borders.
Okay, very good. Thanks for that, Leith. Hand over to Gareth if you like.
We've had an incredible recovery in jobs up until June. At Commonwealth Bank, we'd been very optimistic on how quickly the economy would rebound, largely because we thought if we can get on top of the health outcomes, there is an extraordinary amount of stimulus in the system. That'll generate a broad-based lift in spending and GDP, and that'll turn into higher headcount, which is what we've seen. And then, of course, you couple on top of that the fact that we've just had very little growth in labour market supply with the borders closed. The unemployment rate has ended up dropping very, very quickly. Now, our most recent forecast was for the unemployment rate to keep coming down and to be 4.5% at the end of this year, 4% at the end of next year. But clearly now that's not going to happen, certainly this year's forecast. I mean, the shock we've got now to the labour market, particularly in New South Wales, because of the restrictions, is going to be very, very large. It's a little bit harder to call what's going on in Victoria now, because it might turn out to be the case that you can get the numbers heading back down towards zero and can fully reopen. But I mean, here in New South Wales, we've been in lockdown for the best part of 4 weeks now. And the number of daily new cases of COVID that are active in the community has actually been trending up over that period rather than down. And I put out a note this morning saying, basically we need to consider the scenario now that New South Wales actually cannot achieve that objective of getting new cases back down to zero. And we're stuck in some sort of lockdown basically until the vaccine's been rolled out, or we've hit some kind of threshold around vaccination rates that enable restrictions to be fully eased. So I think right now there's sort of not a lot of point throwing out forecasts given how fluid the situation is. But there's no question in my mind, though, that the national labour market is going to go backwards now over the next 3 or 4 months until we get to a point where the vaccine has been rolled out sufficiently so that restrictions can be eased again. But I mean, the New South Wales labour market is so big that if we go through a big negative shock, which looks like is going to happen right now, then that's going to be enough to take national outcomes backwards.
So I guess a couple of questions. And there's probably, this is a longer term one, is the US seemed to but with pre-COVID, with Trump, sort of you had unemployment rates of hitting sort of 3.5%, and still no real signs of wage pressure. I guess are you thinking? I guess where are you thinking the sort of level at where unemployment actually starts generating wage pressure?
Yeah, good question. I mean, it's one of those things you don't actually know until you get there. But our discussions with our clients, particularly the corporates, a lot of them were telling us that the wages pressures was already starting to come through. Bearing in mind we haven't yet had the Q2 wage price index, so that could show an upside surprise. But we've been of the view that wages growth or wages pressures were already starting to come through. I mean, you can see that in some of the business surveys. I mean, the NAB business survey, for example, indicates that labour costs have been going up, particularly over the last 3 months or so. There's another group out there called Xero that does accounting software, but they've been producing a wage series based on several 100,000 small businesses, and that has really picked up a bit of steam in the last 3 months. So I think it was already starting to occur. I mean, there's obviously lags between what's going on and when the official data is going to pick up, but I think it was already on its way. There was lots of job vacancies in basically all industries. I mean, if you look at the vacancies data, every single industry that we have had an above average level of vacancies as at May. I mean, that's going to change a little bit given what's going on here, particularly in New South Wales. But I think we're already getting to the place where wages growth was going to pick up. Not picking up at the kind of levels that the Reserve Bank wants to see just yet, but we're on the right path. And I think.
And sorry, so what type of levels? I guess because I guess I'm thinking the RBA is going to start thinking 4% wage growth probably all right, and 5-ish is starting to get up there, or have you got a different?
Well, it depends what you think, what they want versus what they would tighten policy on. I mean, they've got an inflation target of 2 to 3%, obviously, and they think that in order to have inflation sustainably within that range, you need wages growth of around 3%. So I actually don't think they were looking to get wages up to around 4 or 5%. 3% is the kind of levels that get you inflation sustainably within the target. Anything more than that, and you're talking about inflation exceeding the target. So I think an unemployment rate around 4.5%, as long as underemployment, and that's a key thing, isn't too high, then that's going to get wages growth up around 3%, which means you're basically hitting your inflation target.
So I guess what you're looking for wages to be sort of in terms of real wage growth to be sort of 0.5%. Is that what you're sort of saying?
Yeah, that's right, and I think that's fair based on what recent productivity outcomes have been like. The reality is that if you're going to have wages growth sort of in excess of that, unless you've got some huge productivity dividend coming through, then you're going to have quite a bit of inflation off the back of that. So our view had been that once wages growth was up around 3%, that'd be enough for the RBA to normalise policy. We thought up until very recently that we'd be in that place by the second half of next year. But I think right now what's going on in New South Wales is really effectively pushing the timing of everything back, given the shock here looks like it's going to be pretty significant.
Gareth, a couple of quick ones. So
Yep.
obviously, coming from Victoria as a bit of a lockdown veteran, you sound a little bit deflated, mate. You're already calling permanent lockdown until the vaccine level. I feel your pain, but cheer up, it will get better. That's no problems there.
Or you'll just get used to it.
Yeah, you might want to start by locking
14
down
weeks,
your
mate.
Bunnings when you have a lockdown.
Oh, Leith, I can hear you now. You're back. Yeah.
Oh, that's good, mate.
Yeah, look, just on the lockdown, I suppose the reason why we're kind of thinking like that at the moment is, we know that the vaccine rollout's underway, so there is a finish line, if you like, and we also know what the reaction function to policymakers is, and that is that they want to get COVID cases right down to zero, or they won't reopen or ease the restrictions in any material sense. And I'm just watching the daily cases and thinking, well, if we're not heading down towards zero, and we've been doing this now for 4 weeks, we're sort of getting to the point where the base case is almost becoming, we just stay this way until whatever percentage of the population has been vaccinated, and then restrictions are fully eased. And that's kind of almost the worst case, but we're sort of drifting towards that with each passing day where the cases are going up rather than down.
It is also important to remember, though, that Melbourne's cases didn't peak, I don't think, till about 7th week of lockdown. So, yeah, just based on that trajectory, New South Wales could have another couple of weeks before it hits the peak, and then it starts to fall down.
That'd be ideal. I mean, and I don't obviously know too much about these different variants and all that sort of stuff, but the consensus seems to be that Delta is far more contagious, in which case it just may turn out to be the case. You can't do what you did previously once you've got too many cases out there circulating around.
Yeah, it's a massive unknown. It's pretty much thrown all forecasts out the window, isn't it?
Yeah, that's exactly right.
Well, and the other thing, I guess the main thing for us then is we've sort of been looking upon this as very much a manipulated market in all senses, whether it be from a federal government, preventing companies from going broke and handing over lots of cash to companies, or the RBA sort of running, zero rates and giving money to banks at 10 basis points. So I guess the question really is, at what stage do you think we start to see more fiscal support from federal government?
Good question. I think if there becomes a sort of realization, certainly in public, that we're going to be faced with restrictions until the vaccine's fully rolled out, then I think you would see the federal government in particular step up with more stimulus. I mean, right now, the state premier here is still sort of talking as though there's a way out of this and that we will get on top of it and that restrictions will be eased. But you would have to think that if every day, with each passing day, if it looks like that objective, not only are we not moving towards it, but we're actually moving further away from it, then I would think at some point that sort of becomes the realization that we are in this for a lot longer than what has been penciled in. And therefore, you almost back solve thinking, well, this is the date we get out of it based on the vaccine schedule. Therefore, what support do we need to put in between now and then, so that when we come out of it, we've minimised the damage that could have been done. We've kept all those viable businesses in the lead up to this still intact, and then we can springboard out of it. I would imagine that's what the thinking is going to be. It's just when that's realised, and you're probably looking at another week or so of what has been going on, knowing that restrictions have been further tightened. And if it looks within a week's time that we're not making any progress, then I would think the narrative probably shifts from policymakers.
Absolutely. Well, also, we've got to remember that the federal government's faced an election, by May next year. So its bacon's going to be on the line. On top of that, we've had obviously the business lobbies, etc., lobby pretty hard for a return of the JobKeeper 3.0 or 2.0. So I think it's pretty much a fait accompli that there's going to be more stimulus coming pretty shortly, if for no other reason, for political reasons, even though it's required economically.
That's right. I mean, it's the policy of least regret too now. I mean, with the finish line in sight, being the vaccine rollout, you've only got to bridge the economy for another probably 3 or 4 months. Why not throw the kitchen sink out of it? If it turns out you did too much, so be it. If it turns out you didn't do enough, well, then you've got problems that you could have avoided. So I think that's ultimately the path they'll go down.
Yeah.
Um,
Gareth, can I want to touch on an area which obviously dear to my heart, and I know you've written about it a fair bit.
Yeah.
But what do you think the impact of Australia's closed border to migrant workers is playing, and obviously tightening the labour market, and what impact do you think it'll have on wages going forward in light of Phil Lowe's recent comments? I pretty much know what your answer is going to be, but I'll put it out there anyway.
Yeah,
It's a
look,
loaded question.
it's something that, and you know this, that I was writing about this pre-COVID, because it sort of seemed like there was this mystery out there as to why wages growth had been so weak. And to me, there was no real mystery to it. It was basically there was an imbalance between the supply and demand of labour, and that meant that wages pressures weren't actually coming through. And I think one of the key reasons why we had that imbalance was the supply of labour was very, very strong, and running a very large migrant intake each year was kind of a preemptive strike on this idea that there were skill shortages in the economy. I mean, at the end of the day, if there were lots of skill shortages, we would have had much higher wages outcomes than what we had pre-COVID. But a lot of people sort of didn't kind of recognise that. Whereas I think what's happened this time around through COVID is that people have realised that and it's obviously been a radical shift, suddenly we don't have anyone arriving, but if you cut off the supply of labour, but you've got a lot of demand for workers, particularly because the government put so much stimulus into the economy, then you're going to get these skill shortages pop up everywhere, and that's going to really shift the bargaining position from employers to employees. We haven't yet seen the wages data turn, albeit that I think we might see that in Q2 wage price index. But I think ultimately, if you've got a lot less growth in labour supply and you're stimulating the economy, then you've got a much better chance of higher wages coming through. I think that would have happened quite a bit actually through the second half of this year had it not been for what's going on in New South Wales. A bit harder to call next year because we don't really know what a reopening of the borders is actually going to look like. But sort of our working assumption is that we're not going to bounce back to the kind of pre-COVID levels of net overseas migration anytime soon. And that'll mean you've got a much better chance of wages pressures actually coming through.
Mm.
Have you pretty much read the RBA Phil Lowe's comments as kind of a veiled attack on returning to those sort of pre-COVID levels of immigration?
Yeah,
that's the way I read it, but I could be reading it through my own biased sort of lens.
Yeah,
yeah, to me, it just seems like he keeps saying that we need to get unemployment below 4.5%. At 4.5%, we need the labour market to tighten further in order to achieve a sort of employment and inflation rate targets and to drive wage growth back up to 3%. And obviously, the flip side of that is if you return to rebooting 180,000 migrant workers into the economy every year, as we did pre-COVID, then that's going to make policy goals a lot harder to achieve.
Yeah, I'm not really sure whether or not there was a political angle coming through it. I think what the governor was doing there is basically giving them or acknowledging that their wages forecast may not come to fruition if it turns out to be the case that the borders stay closed for longer. Because their 2024 forward guidance around the cash rate has really been about this idea that the economy can do well, but it's going to take a long time for wages pressures to emerge and for inflation pressures to come through. And I think they probably saw those job vacancies figures in May against where the unemployment rate was and thought, hang on a minute, the labour market is tightening at a much quicker rate than we thought. Maybe it's going to turn out to be the case that wages actually pressures come through. And part of that story could actually be what's going on in terms of foreign labour. So I think they were kind of recognising that. But it's an interesting one as to whether or not there was a political angle to it, because if there is, what the governor is really saying to the Commonwealth government is, if we're going to meet our inflation target, we're going to see higher wages growth. We kind of need you guys to get the immigration settings right. We'll look after the monetary policy settings, and then we'll have both levers of policy pulling in the same direction to generate the outcomes that we want to see. I mean, that could have also been part of why he said that.
Yeah. Spot on. Well, I mean, he's pretty much spent the previous 5 to 6 years, or however long he was in as term of governor, as basically blaming everything else up until the last few months, where he's finally, acknowledged it in the room.
Yeah, I mean, they had a horrible forecasting record on wages growth, and then by extension, inflation in the lead up to COVID. I mean, there's some funny chart if you Google RBA and wages, but what you can see is a history of what they were forecasting in terms of wages growth for many years against wages outcomes, and they kind of always had wages growth going up pretty much from the end of the mining boom, even though it turned out to be the case for many years, wages growth was slowing. And at no point, over that period did they sort of acknowledge, or certainly publicly, that maybe these wages growth isn't stepping up because there's a couple of 100,000 people, year on year arriving, and the bulk of those people want a job, and that's kind of putting downward pressure then on wages. So, look, it's a fascinating space. I think it's not binary either. It's not like you have closed borders or you have several 100,000 people coming in. I mean, there'd be a level of we don't know what it is, but there'd be a level of sort of net overseas migration that kind of means you don't get, big imbalances between supply and demand for labour, such that employers are saying, look, we just cannot get workers. But equally, you don't have too much supply coming through, so that you can get wages growth up around 3% or higher. So, really interesting space, and then I think the focus will be firmly on it once international borders are reopened, and we're no longer worried about COVID, if you like.
Yeah, it's kind of like a unique experiment that we can run now, which you wouldn't have been able to do otherwise. Obviously, we've got no choice but to keep the border shut. So now we can see the result over the next year.
I guess what I'm wondering, though, from you, in your view, Gareth, do you think that in policy circles, in political policy circles, they've sort of realised, because it does seem that very much the RBA has changed its tune towards saying no, it's not a problem to actually, maybe this is why we got our forecast wrong for so many years. It's now not a good thing, but I guess it doesn't seem to me as if the government has yet come to that same conclusion. And there are they've obviously got a reasonable amount of vested interests in business lobbies and the nationals, in terms of the farmers looking for cheap pickers.
And the Australian Treasury, Damien.
Yeah, the Australian Treasury. So I mean, it's all great to say yes, we've got one of our the RBA's come to the right conclusion, but if the RBA doesn't control it, as we said, and so if the federal government hasn't come to that conclusion, it could be a while yet before we see them lining up. I don't know.
Yeah, good points. It's true. Although I think there's more people than just the RBA kind of recognising this now. I mean, a lot of commentators on the economy, a lot of economists that are reasonably well known have kind of changed their tune a little bit to recognise this. So I think there's a little bit more mainstream support around recognising the idea that the level of immigration has an impact on wages. It's a little bit unfortunate, well, for many reasons, that COVID's resurfaced and we're in a lockdown, but just to focus in on labour market outcomes and wages, it's a little bit unfortunate now that we may not see over the second half of this year the labour market continue to tighten and then wages growth actually really start to come through, because if we were to see that, then we would actually have the evidence to say, look, this is how much wages growth has actually picked up with the sudden drop off in labour market supply. And I was kind of, and this is now sort of not as relevant, but sort of 4 or 5 weeks ago, there's a lot of talk around, if we get any inflation pressures coming through, maybe they're transitory. I was really fascinated as to what the Reserve Bank would forecast around wages growth if it turned out to be the case that wages growth really was accelerating, given the tightness in the labour market. Do they then kind of plug into their forecast this idea that wages pressures are transitory because the borders are closed, in which case they then have to kind of forecast wages growth to go back down, at some point in 2023, say when the borders are open, and then they would be explicitly acknowledging through their forecasts the link between wages and immigration. Now, it may turn out to be the case that they don't have to do that if this shock over the next few months is big enough, but really would have put the spotlight on it. And I think if we did start to see some wages pressures come through, then you'd get more and more support for this idea that wage outcomes and labour supply are linked, which is very intuitive to me. But pre-COVID, there wasn't a lot of support for that. And then you would have more people question, I think, the government's policy around immigration and what exactly they're trying to achieve. What do you really want, guys? I mean, that's another way of putting it. Do you want growth just for growth's sake? Do you want high nominal outcomes? What is it that you really want? Tell us that, and then calibrate your policy settings to achieve that.
Well, there's a couple of I guess on a similar note, one of the things Leith brought up was this the issue about the unemployment rate and the vacancy rate, sort of that ratio being quite low or high, depending upon which one he'd put on the bottom. I can't remember which one it was, but it's sort of at record levels. And that sort of comes back to this whole, this idea of the beverage curve, I guess. And for people who are listening in, it's sort of this idea that you've got a relationship between unemployment and vacancy rate, where when you've got high unemployment, you'll have a low vacancy rate, and then as your vacancy rate gets higher, you get more people employed, and you sort of get this sort of you get a curved line relationship to it. And during the financial crisis in 2008, 2009, that curve seemed to take a big jump up in terms of there's a structural change in terms of you actually needed a lot more vacancies. And I think the reasoning behind that was that you had a bunch of people who used to build houses, and all of a sudden they don't need to build houses anymore. But now there were other jobs but they needed to actually change industries. And I think there's probably a certain element of that within our current system as well, is that we've got a bunch of unemployed airline hostesses and hosts, and you've got a bunch of unemployed people in the whole tourism industry that sort of need to be moved more into other sort of manufacturing jobs or something where there is this demand at the moment, with the idea that actually potentially they'll need to move back at some stage as well once you get reopenings. So there's potentially this, I guess, if there are large structural changes, are you seeing that's a sort of a bit of a one-off hit for wages, or more of an ongoing, or is it just a temporary factor?
Well, I'm not so sure about that, because, as I said, there are above average level of vacancies in every single industry. Now that level of detail does not go down to aviation, for example, and it's clear that that's an industry that has still been negatively impacted through this and hasn't rebounded like pretty much every other part of the economy. But if you take it up a sort of a notch to a higher level, aviation, I think, would come under transport, and in transport there was above average level of vacancies. I mean, it was so broad based. Not
education.
Yep, still above average. So what we had a look at is what is the average level of vacancies as a share of employment for each industry, and how are we tracking now relative to that level. And education, funny you mention that, was the one that was only just above average. So that was kind of the weakest of all the industries, but yet every single industry was above average. So I think and I should sort of add as well, if you cut up the data other ways, and the IBI, Internet Vacancies Index, the government one, is very good for this. You can cut up the job vacancies by skill level, and of course you've got them by jurisdiction. And it didn't matter which way you were cutting them up, as at kind of just gone the last few months. It was every industry, it was every part of the country, and it was all skill levels. So it was an incredible situation. I mean, we've never seen that kind of imbalance between vacancies and the level of employment. And that gave me so much confidence that we were going to see very, very good outcomes over the second half of this year. Obviously, that was conditional on COVID not coming back, and it's a different story now, but the data looked incredibly good.
And how much of that would you put down to, obviously businesses, and in particular small businesses, got some pretty decent benefits from governments in terms of PAYG and things like that were returned, and I guess it's sort of a lot of things that probably didn't occur to people at a top line level, but there was sort of the government was obviously very generous to businesses, and as that starts to fade off over the next few months, I guess how much of the do you put down to that, or how much do you think of it is actually just really a genuine, real bounce back, and it's and the lack of supply?
Well, I thought at the time it was a real bounce back, because we had JobKeeper expire at the end of March, And there was a lot of concern at the time around, we might see some job losses over the next few months with that expiry. It turned out to be the case that employment growth hit a little pothole in April, and then, as you said at the beginning, it jumped by 115,000 odd in May. I was up by around 30,000 in June. So the government was able to withdraw the stimulus, but because domestic demand was so strong, households were sitting on so much in the way of savings. There were lots of other programs, home builder and whatnot, supporting construction, and the economy was doing very, very well. And of course, Australians weren't holidaying overseas, so given that we've been spending twice as much holidaying abroad as what we get from overseas tourists, there was a lot more money that could be spent domestically, be it on holidays or just other goods or services spend. So I think it was genuine, and it kind of shows, and we should sort of add as well, interest rates are record low, so that you're obviously getting the support from monetary policy. But I thought that the economy was in a brilliant position, to be honest. As at the end of June, we were going to see very, very strong outcomes through the rest of this year had it not been for COVID. And the business surveys were reflecting that. I mean, the NAB business survey, as much as I don't like giving other banks plugs, I mean, that's a very good survey. And that was, we had reads on business conditions and business confidence at their highest level in the survey's history, which goes back to the 90s. Capacity utilisation was very, very high. I mean, consistent with an unemployment rate down near 3%. So the economy was really roaring along, but it's just hit a massive setback right now, given restrictions have been imposed in the two biggest cities.
It's also important to remember, and Gareth touched on it, that households have saved $200 billion worth of savings in the March quarter, which is by far the biggest, mountain of savings we've seen on record. And that's effectively pent-up stimulus. Stimulus that's now available to be spent, the quarters ahead. So that just gives a massive tailwind for consumption and housing, everything.
Yeah, that's spot on. And then you can also throw in the tailwind of rising home prices, which makes people feel better, so they spend a little bit more. Commodity prices, at very, very high levels. The resources sector has been doing very well. I mean, before this lockdown, I was over in WA seeing a range of clients over there, and I mean, all our clients in the mining industry were loving life. You had a whole lot of circumstances which were just so supportive of the economy, but we've thrown a bucket of cold water over it with these restrictions. But it's amazing to think we came out of our biggest shock in kind of as far back as you'd like to go, and with all the stimulus put in, coupled with a few other things that were working in our favour, we ended up within an economy that was sort of firing on all cylinders in a way that we hadn't seen since the mining boom.
And so the question, so do you think in policy circles, then they'll be going, okay, we just need to do the same thing again. We need to make sure we've got a big stimulus coming, or are they sort of like, well, we've had our big stimulus, let's just try and keep things to the minimum we need to keep things ticking over?
Yeah, I mean, good question. We'll kind of find out, I think, in the next probably couple of weeks. But I would think they'll go big again. I mean, as I keep sort of coming back, the finish line is in sight. I mean, if we didn't have a vaccine, or it looked like there were problems with it or whatnot, and we're talking years away, then it might be a different story. But if you sort of back solve for October, November, where the vaccine rate should be at a threshold when you can reopen, then you're kind of talking about supporting the economy only for another 4 months or so. I mean, there's not a lot of downside in my mind of going big. At the end of the day, if it turns out that by going big, you end up generating more inflation and whatnot off the back of it, well, in a lot of ways, the Reserve Bank's been trying to achieve that anyway. So why not do it? And actually, just on that as well, I should say that I think there's been a shift in fiscal policy more generally, and we saw that in the May budget this year. I mean, the stimulus that we had put into the economy last year was quote unquote sort of emergency support for the economy, and it was possible that the government in May this year sort of embarked on a budget repair style strategy, showed that they wanted fiscal restraint and tried to kind of come up with some policy changes that meant not that we got a balanced budget, but that the deficit came down at a rate that's far quicker than what they've got penciled in. I mean, the fiscal settings in the budget this year were very expansionary, and the additional kind of money that the government got relative to their forecasts from higher commodity prices and a better performing economy, they effectively just plough that in into more expenditure. So I think that the government sort of come to this realisation that maybe big spending's not all that bad, and you can generate some pretty good economic outcomes.
Deficits don't matter,
especially with the election next year.
Well, that's right.
For mine.
Yeah, this is a global thing I should add too. I mean, it's the same in the US at the moment. I sort of feel like governments have kind of started to realise that, hang on, you can run these big deficits, you can do it at low interest rates, the central bank can buy the bonds. What's not to like about spending money at the moment, because the voters like it.
Yeah, can I just say, the one thing I'm looking at overseas, probably more than anything at the moment, is actually what's going on in the UK. So UK declared Freedom Day on Monday. So basically they lifted all remaining COVID restrictions. And the UK is pretty much the highest vaccinated country in the world at the moment, at least fully vaccinated. And I think it's pretty much will point ahead to the rest of the world whether we can fully ease restrictions or not the next few months ahead, because a lot of pundits are saying that the UK is now going to have a massive explosion in COVID infection. But the thing to look is not actually COVID infection. It's going to be on the number of hospitalisations and deaths that come out of it. And if we get a situation in the next week whereby the UK is fully open up, it's highly vaccinated, and hospitalisations and deaths don't explode, that's pretty much the road. We'll present the roadmap for Australia and other countries going ahead. On the flip side, if the UK fails and they get a massive ramp up in COVID infections, hospitalisations and deaths, well, then that's going to throw the opening up narrative out the window. So that's kind of the one thing I'm looking at most at the moment overseas, because it pretty much is a litmus test for Australia as we, embark on our vaccine rollout. What do you guys?
And I'd argue that, I think you're absolutely on the point, and I'd argue that the US as well offers not a bad sort of petri dish as well, insofar as they've got some states that don't have high vaccination rates and other states that do, and so you've actually got within the one country you've even got areas that have and haven't, and sort of trying to work out what the right level is. They're effectively running a big experiment across the whole thing, going, well, is 40% enough? Is 50% enough? Is 70% enough? Across all these different areas to see what the key number is.
Yeah, and I'm certainly looking at the UK and hoping that it succeeds.
Yeah, I completely agree, Jensen. That's the thing that financial markets are really focused on now too. I think if it turns out to be the case, within a couple of months that UK hospitalisations have not gone up at all despite a surge in cases, then I think there'll be a real sense of risk on in markets because 2022. Risk off because 2022 you can see that the global economy is going to do incredibly well because COVID will be a thing of the past, which is ultimately what we all want.
No more lockdowns.
Just on that, I guess, Gareth, thoughts, I guess, on we've spoken a little bit around the vacancy piece, and you mentioned there that there's not a whole lot of data on the quality of the vacancy. But for mine, is there an element of reflection maybe on where on a spike being in the vacancy rate recently that'll sort of ebb away as people are sort of using perhaps the lockdown period as a time to think about sort of their next thing. So it's sort of like, in a way, there's a financial element perhaps to it, but also just it's a chance for people to review what they're up to and change from there. It's a little bit abstract, but is there anything you thought in that from your end?
Yeah, so I mean the vacancies data is going to shift quite a bit. The next official ABS read will be August vacancies, but you probably want to look to the higher frequency vacancies like the ANZ series or the IBI series to get a sense just of how much this lockdown has actually changed things. I mean, it's going to have a big impact on New South Wales without a doubt. There'll be lots of businesses that won't be hiring through this period, and by the same token, there'll be lots of businesses that are actually standing down staff. So it's going to have a really big impact. Victoria, it's harder to say at the moment because we just don't know how long your lockdown is going to go for. And then for the other states, it might turn out to be the case that, what's going on here in New South Wales and Victoria doesn't really have too much of a negative impact, and local economies can still do quite well. So I think it's sort of all up for grabs at the moment. But you've kind of got two different opposing forces at work at the moment in terms of businesses thinking about making kind of decisions for the medium term. One is you've still got all the uncertainty around lockdowns, which might see some investment plans shelved for a little while, or some concerns around putting on more staff or expanding or whatnot. But then you've also got the vaccine rollout occurring, where you can kind of see the finish line around sort of October, November. So, and to the piece around watching overseas, I mean, even if we're in lockdown, for example, here in New South Wales in 6 weeks' time, but you look overseas and the UK is doing fine with, fully reopening, then I would think a lot of people kind of look through the pain that we're in right now and say, look, 2022 is going to be a very good year. There still looks like there's going to be lots of support for the economy from government. There'll be lots of stimulus. I mean, the amount of savings is going up literally every day, given we're in lockdown. There's going to be so much money there, and I think there'll just be so much pent-up demand for households to want to get out and spend some money and do some things. So I kind of think, the medium-term outlook still looks very good, and you'll see the labour market, I think, tighten quite a bit through the next.
Right, might be close to time to wrap up anyway. I was actually just putting out. I don't think we've got too many questions on board.
Yeah, that's a good one actually. Yeah, anybody who's got any questions, feel free to drop them in. Hopefully, we can get Gareth back.
I'm here if you can hear me.
Today.
Oh, yeah, there he is.
Oh, yeah, we can hear.
Back. Yep.
You're right.
No, it's all right, mate. It's just the internet's playing up today for all of us, I think.
Yeah, I don't know.
I think someone had tried to call me, and that's what stuffed it up.
Oh, right, yeah. Actually, well, just sort of just following on for that as well. In my experience, and I speak to people sort of all over the country that got interest in investing with Nucleus Wealth. One of the things that sort of struck me, and I guess, obviously there's Sydney and Melbourne from a quantum perspective, are huge components of the economy. But from the people I've been speaking to are, perhaps more regional, haven't been affected by COVID, if at all in some cases, particularly looking at you, Queensland, and yet have, picked up an enormous component. Well, basically all the, from a business perspective, the cash flow boost and things like that, all the way around the country. It's easy to sort of focus on the pain points in the big centres, but for mine, that's almost certainly got to lead into this this unemployment rate. Have you done much of a look into where it's sort of coming from? Is it are we finding there's actually very low levels of unemployment through the regions that have effectively, in some cases, I'm speaking to small business people where they've had a 100% increase in in their revenues for the year, obviously through the government stimuluses and whatnot, and that's going to naturally feed into them wanting to hire longer or hire more. Is there much data on that?
The ABS produces data at the regional level, but it gets pretty ropey. The more granular you get, the more volatile it is. But I would sort of, like you said, rely on your kind of discussions with businesses there. I mean, I did a few trips to kind of regional Australia not too long ago and speaking with various clients, and there was a very similar message coming through from everywhere, and that was it was actually hard to attract workers, and business was booming. Now, it might be the case though that this lockdown in Sydney has a spillover negative impact to regional New South Wales if people can't go and holiday there and whatnot. But without a doubt, regional Australia has done incredibly well through the COVID period, and you're kind of seeing that. One bit of data I would rely on is around rents and property prices, and you're seeing in regional Australia, both rents and prices surge. It's really reflecting a lift in demand for people to go and live in different areas, and that's been a positive shock for regional Australia.
Yes. So, well, I actually wanted to ask you your thoughts on property. So I guess there's a couple of things there. There's obviously a lot of building going on at the moment, and low population growth. Is there I guess in terms of demand supply, There's obviously a lot more demand for houses at the moment, but houses are much faster to build than apartments. And I'm just interested to know, when you think that supply will catch up with demand, if that's a prospect over the next few years.
Well, I guess it depends what happens with the international borders and what we see in terms of the flow of people coming back into Australia, because that'll have quite an impact on the change in the flow of dwellings against the change in the flow of people. It's been amazing though, really, that we've had kind of the international borders closed, building a lot more properties, and yet rents are actually going up as well as prices. And sort of outside of Sydney and Melbourne, in the apartment space, I mean, vacancy rates have been well anchored. So you kind of think, well, how does all that work? Like, what's the missing ingredient here? I do wonder if there's a little bit, there's a few changes in household formation actually taking place. So I kind of think you've seen a lot more first home buyers in the housing market, and a lot of first home buyers would either be living at home with their parents, or they'll be renting and potentially in a flat share. So if you've had a kind of an increase in the number of people that had been living at home that have then gone out and bought a place, an apartment or whatnot, and moved into it, then you can actually get the stock of, or you can be taking down new supply and dwellings without actually changing the population. And yep. I think that might be at play equally. And I haven't seen data on this, but I do wonder too if we've seen an increased use of, particularly in regional Australia, of properties for Airbnb purposes. So taking advantage of the fact we can't holiday abroad, more people going to regional Australia for holidays, and therefore people have been buying properties, turning them up to use it as Airbnb, and then you kind of reduce the stock there. And one other thing I might think might be happening is, because so many people are now working from home, particularly in Sydney and Melbourne, that previously you might have had two people in a 2-bedroom apartment, and there's kind of a realization that if you're going to work from home, you can't really do that if you've got a flatmate, and therefore you get a 1-bedder living on your own, or you get a 2-bedder and convert a place to the office. So all of that, I think, would ultimately helps to explain why there hasn't been much growth in population, and yet lots of supply of dwellings coming on, and no real shift in the vacancy rate.
Yeah, so
most of the supply is not coming on until next year, though.
Sorry, one of you go again, Leith. That was a bit.
I was going to say, although approvals and everything have gone through the roof because of home builder, most of the supply actually won't hit until next year. It's currently under construction now, so we won't actually see the supply hit until 2022, when we'll see a tidal wave.
Well, and then I guess it's this question, isn't it, about saying, okay, so I think, like, I'm on board completely with you in terms of, I think it is household formation, as you said, lots of extra savings and all that type of thing, and people, and the structural bit where people moving out of, say, Sydney and Melbourne apartments and into houses more likely, whether it be regional or even just within the same city, and it sort of feels as if, well, that's doesn't seem like a long-term trend. That seems like a shorter-term trend in terms of, if you build up a bit of savings, like you've got a year or so to run for that, but maybe then you get your hand off as then your borders open up again and more people come in. And so your perfect scenario for a housing market is you got this extra demand for a little bit, and then the borders open, and that sort of drives your housing demand even further. But your flip side is, if it's just a sort of a one-off structural change where you get a boost in household formation, and you get a bunch of people wanting to move into houses versus apartments, and then you don't have a huge influx, and you get a wave of building, then maybe that sort of helps match the supply and demand up. And so, I'm guessing it's probably more the former, but it'd be interesting in your thoughts about whether it's is it a handoff, or is there going to be a bit of a gap, or does demand and supply sort of reach?
Yeah, it's hard to say at the moment. I mean, I think there's a story still we don't know the answer to as well, and that's around, once COVID goes away, what number of days is it acceptable not to be in the office, or can people work permanently remotely, and all of that I think is still up for grabs. And I think if it turns out to be the case that there's a decent enough number of employers out there who say to their workers, you can actually work by and large remotely full time, but occasionally will need you in the city, then what you might end up seeing is people, and these are people that are fortunate enough to own a home in Sydney or Melbourne, potentially selling their house, buying an apartment in the city, and then moving somewhere regional and owning a house there. I mean, I know a few people have already done that. And again, if that was to take place, you'd end up with, you'd end up taking the supply of dwellings down by virtue of the fact that you've got more people out there owning 2 properties. And so that wouldn't surprise me if a bit of that takes place over the next few years. But look, I think ultimately resi construction is going to slow because home builders clearly created a boost in home construction that's not going to last. And for what it's worth, our kind of forecasts are for resi construction to kind of slow over the next year, pretty strong in the next kind of 9 months or so, and then come off. But when thinking about property prices in the main, I think everything we've sort of learned over the recent past is that interest rates are the most important thing when thinking about the demand for property.
Yes, absolutely. And we are seeing interest rates sort of at the margin just starting to tick up, I guess, as the RBA's term funding facility is finished. Are you expecting that to continue? Or have you got sort of forecasting that to continue, or you think that most of that's already in?
Well, we thought that the fixed rates would continue to go up in line with the market pricing in rate hikes, and but I think for the moment that's kind of market pricing for hikes has been taken out because of what's been going on with COVID. So I don't think the fixed rates will be going up too much too soon now until we get through this and markets go back to pricing in rate hikes. But ultimately, when that happens, the fixed rates have got to come up quite a bit because they're quite a bit below the standard variable rate right now, and a lot of that's been because of the term funding facility. So I think interest rates will drift higher, and that'll take a bit of steam out of the housing market, but they're still very, very low in a historical sense. And I think households are still willing to pay. Well, lending's still very strong, just by virtue of the fact that anything with a 2 handle on it, I think, seems pretty appealing to households.
As a mortgage rate loan.
Yeah, that's right. I mean, that's a very, very low level. Yeah. It's below the rental yield in so many markets, which means if you can afford to, it's more attractive to buy than rent at the moment.
Sure. One that I might just ask, probably for our audience more than anything, although it hasn't come in today, but it does get asked quite a lot. But I think you're a perfect guy to ask. Is popping the forecasting hat on. So we get a lot of people who obviously reviewing an investment with us. Who are less than enamored, let's just say, with the term deposit rates that are available now, and probably for the foreseeable future. Obviously with the term funding facility potentially will roll out, or it is rolling off. There's going to be pressure on bank margins. But what are your thoughts on term deposits? Where would they be perhaps in the next 2 to 5 years if you're going to throw the forecasting out? Won't hold you to it, of course, but yeah.
Look, I mean, it's ultimately the banks that set those rates, but I don't think they'd be going up in any material sense until the cash rate's going to go up. And the cash rate at the moment looks like it's going to be on hold for a few more years. I mean, as I said, we thought November next year would be when the Reserve Bank would finally get around to raising the cash rate, but that was not taking into account the latest lockdowns which were going in. So if that's pushed out until 2023, then I wouldn't think you'd see the term deposit rates rising until then. I mean, they're going to probably end up tracking what the cash rate does. Mm-hmm. It still looks like we're quite a long way away from when the cash rate might be going up. I should just add to, just on the cash rate and any tightening cycle, I mean, the stopping off point or the end point for rate hikes is going to be very, very low. And this comes into this idea of where a neutral interest rate is, or basically what is the level of the cash rate right now that would be consistent with inflation within target and full employment. And it's going to be lower now than it has been at any other point in recent history because households carry so much debt. So you get a lot of mileage basically out of a few rate hikes, and we think that
even just jawboning a rate hike probably.
Well, that's right. I mean, it kind of as you get lower and lower, each rate cut has an exponentially large impact on the interest cost of debt. So that goes down very quickly, but it means the reverse is true. So the interest cost on debt will go up very quickly with a few rate hikes. So we kind of think the central bank only has to get to about 1.25%. And you've kind of taken the cash rate to a normal or neutral level. So that's going to mean that even if term deposit rates go up, they're going to end up still at a very low level and probably be in real terms, you'll get a negative interest rate.
Well, actually, just on that, obviously historically, 25 basis points being the unit of increment. Do you see them perhaps even needing to halve that perhaps or reduce it in order to avoid the effect that you just mentioned, that exponential effect?
Well,
I think if it got to the point where they were a bit worried about that 25 might be too much and they would do 12 or 13, then they probably shouldn't be raising interest rates. I mean, I think by the time you get around to realising that's the right policy choice, then you've got to be confident that you can, be hiking in 25 basis point increments. I mean, I think they've got to do the first one of 15 just to get it onto that 25 increment, given the cash rate is it's 10 basis points now. But after that, you'd move in 25s, but you probably just don't need to move too aggressively. So, one or two, get you started, wait and see what happens, and then you move, you keep tightening if you think you need to. But I think the main point is, and the bond market kind of reflects this, is that you don't need to go too high to get back to a level which is kind of has the economy in equilibrium. And I suppose if you then think about it, that level being very low, it just means next time a shock comes around, we don't have too much rate relief that we can give households and businesses.
Yep. All right, very good. We are running out of time. I've got a question, but is there anything else from you, gentlemen? Or I might just flick over to the question and we'll leave Gareth to get back to his senior role, his day job. You okay, Jed?
Yeah, we're good. Yep.
All right. What have we got? Okay, sort of Danny here. How does Australia's job recovery compare with other economies like the US? What advice would you give to a Year 12 student on what career to choose when considering an uncertain future? I'll go to the chief economist of the Commonwealth Bank for that one. Good on you, Danny. Have you got any thoughts there, Gareth or fellas?
On the career?
Australia's job recovery, perhaps in relation to other economies like the US. I touched up a little bit on this earlier, but
yeah, up until June, I mean, we were the standout. We had a better labour market in June than we had pre-COVID. There's not many countries around the world that are in that place. So we looked very, very good at that point. But now with each passing month, kind of directionally, we're going to be heading a little bit backwards while other countries are moving forward. So probably won't know until next year how we compare versus everyone else. But as at the middle of this year, or just 4 weeks ago, we looked very, very good.
Okay, fantastic. All right, mate. Well, look, thanks very much once again for coming on. Almost, as we mentioned at the start there, almost exactly a year from the last time. Hopefully we can make it a little bit shorter next time. But just while we got you on the line, of course, just share perhaps how obviously our audience can follow some of your work and track what you're doing out there and all the good work you're doing.
Well, look, we've unfortunately our research website, Commonwealth Bank, is password protected, but we're going to be shifting to a model soon where that doesn't need to be the case. So when that happens, all the research will be publicly available. In the meantime, we used to have some issues with compliance around what we could publicly put out and what we couldn't. But fortunately, speaking of restrictions, those compliance restrictions have been eased. So we can post a little bit more on LinkedIn now. So I've sort of more recently put up a few notes that I think are relevant for people. So if anyone wants to just add me on LinkedIn, they can get up. They can then see the stuff that I put up. Fantastic. All right, no worries. Well, look, from the team as always, thanks for coming along, mate. We look forward to getting you on again really soon. Nice to chat, and hopefully the next time we do this, we'll be third time lucky, and we won't be in a lockdown. That's all right. Yeah, and hopefully the technology helps us out a little bit more as well. So anyway, no, that's all good. We'll roll across to our viewer question of the week, and so feel free to drop your answers in the comments here. Of course, how low will the unemployment rate go? It's an interesting question. Always, and perhaps why as well, if you like. Just don't drop in a number. We're always happy to read that and reflect on that. So thanks to everyone, fellas, as well, Leith and Damien, as always, for a very good show. And we'll jump into the end notes. Thanks again to all of those who've watched in for live for another great episode, and I hope you've and of course to Danny, I think it was, who's asked a great question. Didn't get a lot of questions today. We've had plenty to talk about though. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video now to give us some feedback.
If you'd like to stay up to date or see more of our content, head over to nucleuswealth.com/content. To stay up to date on news from us, follow us on social media. And finally, if you know anyone who gets something out of today's episode, let them know about it, share with a friend and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team, and we'll look forward to catching you with the next one. Cheers.